Bill said, here's a couple of trades you might want to discuss on today's webinar. I had a bull put credit spread on Fortinet, FTNT, that plunged through both strikes overnight. I closed the position and ate the loss. I think it might bounce due to short covering and such, but I didn't want to risk the assignment. I'm wondering about your thoughts on it. On July 14th, bought the August 18th 65-60 puts. Bull put credit spread. We'll show that in just a moment. Bill also said, I also have a married put position on the same stock, and I'm holding on, hoping for some sort of rebound. Purchased July 14th, bought at 69.49 with the January 19th 75 strike put. It's that married put position I referenced before. Similar married put position that I'm in the Fusion portfolio at RadioActive Trading with different prices, but we're going to take a look at that also. So let's use power options. Let's take a look at Bill's positions. Let's talk about how I was able to enter Bill's positions into the portfolio, of course, and talk about some management ideas and non-management ideas in other cases. So I'm going to switch over to power options here. There we go. Let me make sure that we're looking at the same screen together. Yes, we are. What we're looking at here is just the main home page of a trial account to power options. Now, we're going to go to the portfolio tools here under my portfolio. We're going to access the portfolios where I've entered in Bill's positions into something called the FTNT, the Fortinet trades. Now, Bill mentioned that he bought the, oh, shoot. Sorry, folks. Let me do this real quick. I'm sorry. I did something bad. There we go. Delete leg. Sorry about that. All right. There we go. So here's Bill's position. I apologize. Bought the stock on 6/6 at 69.49. Bought the January 75 strike put for 9.30. He didn't mention that as email. What I did is I used the Power Options historical tools to show what was the price of this January 75 put on June 6th. If this on that date at the close, 9.30 was the midpoint, so we just went with that as the price. What is this married put structure? Well, it's a protected position where he's bought a stock at 69.49, paid $9.30 or $930 for one contract for the right to exit the stock at $75 per share. Here's the right, to force someone to buy his shares of stock at 75 no matter what happens. Action today, stock's down 25%, roughly 19 points from where it was, down to 56.77. And this was due to an earnings event. Stock had been moving along, been flirting with the 80 strike. The 80 price line just a couple weeks ago. Had a dip recently. Had a big pull down here the other day. That actually helped me. I'll show you why in a moment on my position in RadioActive Trading. And then the earnings plummet down 25%. Another big drop today was DOCN, Digital Ocean Holdings. It was also down about 25-30% today as well. And that's the trick with earnings. Thankfully, we're in a married put position. Why do I say that? Because remember that the married put position gives you a structured trade where although you paid a premium for that put option, you have the right to force someone to buy your shares of stock at that price, even if the stock goes to $1 per share. Bill's position with just 100 shares, I don't know how many shares he has, but just as the 100-share view, total invested was $78.79. 75 put gives him the guarantee that the worst case scenario, he can get back $7,500 on this trade. The maximum risk is $379 or only 4.8%. He opened the position on 6/6, and he's thinking about what to do potentially with this trade. Now here we are in August. We're about 2 months away. Fortinet does offer weekly calls. Let's say you sold out of the money weekly calls for 0.5%. Well, you might have reduced the cost basis by 4%. But now the stock's down 25%. You're still at a 21% loss in the position. Where Bill's liquidation value, it's near the full loss for the trade, the maximum loss for the married put. With that 25% decline, he's only at a loss of 4.4%. So I'm taking this one first because it's the more difficult one or the easier one to discuss. And he says, I'm holding on hoping for some sort of rebound. Any thoughts on this one? Now, there are ways that he could potentially manage this position. Adjustments he can make with this put. He's got a gain of $12.15 in the put to offset a loss of $18.99 on the stock position. Now, the full course on the married put technique that we use is discussed in what's called the Blueprint. And this discusses not only our preferred structure for getting into the married put trade. I'm sorry, here we are at the married put tab. You see the link to the Blueprint here. You can also check it out in the store as well. But in addition to the preferred structure that we use, why is the put so far away? Why did he buy a 75 put when the stock's at 69? That's for the proper controlled risk, putting time on our side, and meeting the 3 core principles of radioactive trading, which really apply to any options trade. Well, the rest of the electronic course goes through the 12 different income methods, ways that we can generate premium, make adjustments to the trade to lower that initial at risk, lower the break-even potentially, lower the cost basis, of course, and potentially bulletproof the trade where we have no risk on the position to the downside as we keep generating income and moving that break-even further and further down while keeping the higher protection in place. So, one of the concepts that you could do, Bill, and one of the things you might consider, sure, you've got time. You've got 168 days on the position. I never try to react on these positions, the married put position specifically, right away after an earnings with a sudden event. I don't want to try to chase the put prices, the midpoint prices. I don't want to try to chase the implied volatility fluctuating up and down. Got a few days to wait to see if the dust settles after these earnings. By the way, Fortinet dropped so much because they lowered their yearly guidance. They didn't miss revenue that bad. It didn't seem to me like a 25% drop at all for this quarter. But adjusting the yearly expected revenue, that naturally put a hit on the position and had analysts readjusting their targets for the trade. And we saw that 12-point drop, $19 drop today from where it was around that $74, $75 range. All right. And how can we see what can happen? Well, anytime you're tracking a position in the PowerOptions portfolio, whether it's a married put, whether it's a covered call, whether it's even a long call, for example, always link to position actions and then position analysis. The position analysis tool will give you a breakdown of your current trade, similar to what you see here. What is my current liquidation value compared to my future expiration value or loss on the position if I hold it all the way to expiration and the stock remains at the same price. We get some insight into the position, the static profit and loss chart, our original position value, more breakdown and more details if we want of the breakdown of the current liquidation value and future expiration value. How does the math work? And if any opportunities are available, they'll show down here in the rollout opportunities. And we see here some positions for income method number 9, which is something that you may or may not want to use, but it's an adjustment that can be made. Remember, the initial break even on the position was a total cost basis of the stock plus the put of 78.79. Stock is now at 56.77. I'm going to wait for a few days for the dust to settle. I want to see what can potentially happen, what other news comes out if the stock starts to not necessarily rebound with the short covering that Bill mentioned, but we start to see some other stabilization, or maybe in a week or so after this large dip, we see some stabilization and might see a gradual move up. Not back to 75, not back to 74. I mean more along the lines of moving back up to maybe $60, $61. Why is that important? Because you see some adjustments here where we can roll the put to a lower strike price. It will increase the risk on the position, but we're going to be able to drop the break-even price on the trade with still leaving 150, 120 days out in time. Let's just take, I like this one because it's in the $69 range. It's still pretty far away, I admit. But let's just take this strike here. The January 64 put, we have a 75. So we're going to lower it 11 points. We're going to sell to close our 75 at 18.55 and buy to open that lower strike put for $9.40. We're going to pocket $9.15 on this position, which is going to drop our break even at $9.50 from that 78.79 down to 69.64. This will, however, increase the risk on the position, and that's something that you have to consider. Full details of why you would do this, when you would do this, are discussed in the blueprint. Advantage: I've lowered the break even on the trade from 78.79 down to 69.64. When you simulate the trade from those rollout opportunities, you see a side-by-side comparison of your two positions. My initial position in red on the left, a max risk of 379, 4.4% loss right now if I liquidate, still with a break even of 78.79. Or take a higher risk of $564 or 8.1% of what we have newly invested in the position at the lower price of 69.64. Still infinite upside if the stock recovers, knock on wood, and still ability to potentially do adjustments as we see the stock to recover. What would I look for when the stock recovers? What am I looking for when this happens? What I might want to look for in consideration with this is what we kind of talked about with the long call aspect for Kevin. Very briefly, I understand. But let's just go in the past of the profit and loss chart. We've got a huge MACD gap down. And we don't have any other ones here recently, but back in the past, we had a negative MACD crossover as the stock was sort of hesitating. And we had like another little one here, but not too much. But if I start to see the lower MACD stabilize and start to curve up while this one is still declining, and I start to see that next positive crossover, if the stock slowly starts to come back up to say 60, 62, and this might be 10, 15, 20 days away, you've got the time. You're only at a loss of about 4.2% with a maximum loss of 4.4% with 168 days of protection. Potential that the implied volatility on the put option increased a little bit today, so maybe you can get out, but you're still near that maximum loss, Bill, based on the numbers I think that you're in. So what's the problem with waiting? You've got the time. This might be salvageable, but following the rules in your blueprint, check out that chapter on income method number 9 and when you might look to adjust this position. But it's a possibility, okay? There's other discussions there on income method number 12. I'm going to touch base on that after I discuss your bull put credit spread. Would that help you in this situation? Not necessarily, unless we continue to see further declines in the stock. That's also discussed in that blueprint chapter as well, the blueprint chapter for income method number 12. So there are ways to manage it. Considerations. You don't think it's going to recover. It's not worth your time. You are absolutely in the proper structure to begin with a max risk of only at 4.8%. You're only at a 4.4% loss with a 25% decline in the stock. Nothing wrong with liquidating, taking the small loss, and moving on from the trade. If you think it's going to recover, if you're comfortable waiting a week or two on this trade to see what happens going further, worst case scenario, absolute worst case scenario, even if it goes down to $25 per share, you can only lose 4.8%. You've got time. I can't give direct trading advice, you know that, but you might want to hesitate, wait on the position and see what happens. I said I was going to talk about your bull put credit spread first. I'm not. I'm going to stick with the Fortinet and the married put trade at this time because we're going to talk about my position. Now, my position was actually, let me go ahead and add this in. I'd added it to yours by mistake. A few weeks ago, I had sold this Friday's. I'd rolled to it. I'd sold a 74 call on Fortinet. The stock had gone through 74. This was for July 28th or July 21st expiration. I think it was the 28th expiration. And it had gone up to 78, and then it pulled back down to 76. So when I had a chance to maybe roll for a decent credit, it's not even there. I got to view all options. Hold on, let me pick the right option. I sold the 77 strike call for today's expiration for a price of $280. And this was when the stock was at 76.50. And as I mentioned, it was probably on the 28th. So I had the married put position. Oh, Put it wrong. I'm sorry, folks. I put that in the wrong place. There we go. And again, the stock was at 76, 70, 76. Let's call it 76, 75. So it was at the money, taking advantage of the at the money bell curve, sold an at the money call. Now, the position at the time looked like this. Something's wrong with this method. It wasn't bulletproof. It had a risk of only 0.3%. What does bulletproof mean? A negative maximum risk, meaning that even if the stock fell, still guaranteed to make a profit of 4.3%. This is the webinar account, so it might not be 100% actual to what trade is posted at RadioActive Trading for the Fusion portfolio and what's in my personal account. But in any case, as we saw with Fortinet, I had the 77 strike. Sorry about that, folks. And that was open during this time the stock went up to 80 and was in here. It breached that strike. I didn't want to buy it back yet. I didn't want to have to roll again to the 82 or the 84, so I just held on. And it pulled to the 78 range. I was happy with that. And then these last 2 days before earnings had to drop down to 74 and then move back up to about 76. That was enough for me to close for a reasonable profit. Implied volatility was still very high because earnings were coming out today. But what I was able to do, is close that long call yesterday for a price of about 146. Okay, so let's go ahead and close that. I'm going to close the leg here. And yesterday, the 3rd, we closed this for a price of 148. 146, I think it was actually. Why did I do that? Well, because I didn't want, there we go, sorry folks, the upside capped, as it would be with selling the call. I wanted to leave the upside open. Okay, I could have gotten another $1.30 out of it or so by leaving it open, of course. The call would be worthless today with the massive decline. I actually had other expectations. I was wrong. But I had a controlled risk in place of only 2.4% after buying back the call. And so now I'm in a similar position as we talked about. My price is 62.60. I have the 730. I have the September 70 put much closer in than Bill's does. I've got to make a decision faster because I only have 42 days to expiration. Am I going to roll to January and the lower strike? That's going to be determined by what the stock does in the next couple of weeks. With the stock down, 25% today or 9.3% total from my initial cost basis on the stock. Am I comfortable with only taking a 2.4% loss? Yeah, I don't like to take a loss. I know you don't either. But in this unexpected scenario, complete different expectation, the risk is controlled. Now, I could have done something fun with this trade, and I considered it. I'm trying to see my notes here from yesterday and the day before, but I don't have it. I try to map out different strategies. We're going into earnings. I knew I wanted to close the call. I got an opportunity to close the call at about 50% profit from the premium I sold to not leave the upside cap, to leave the upside open. But going into earnings, something I could have done. Let me go back to this portfolio here, but actually go to the chain. One of the income methods in the blueprint is this nifty little thing we like to call income method number 6. You can generate premium on a position, similar to selling a call, but you're going to take some of that premium to buy a higher strike call, essentially doing a bear call credit spread on the married put position, which leaves the upside open. Because I have a stock, a sold call, and a long call, that even if the stock shoots up above both strike prices of the long call and I quote-unquote take full loss in the bear call credit spread, I have more of a gain in the underlying stock that was not capped by the short call because it's covered by that extra long call as well, if it breaches through both strike prices. I'm going to go to August 18th. What I'm looking at is the historical change from August 3rd. The 77th strike was at 260. Midpoint at the close. And I don't want to use the 80. Let's use the 82 at 105. Okay. So the 77, 82 at 105. So I'm going to get in a net credit of about 155. I'm going to sell the 77. This was for the 18th of expiration. I would have rolled to that call and bought the 5.1, the 105 on the bear call. Let's take a look at what that would have looked like. Let me clear this out. And I'm just going to change a number real quickly because I know my risk was about 2.4% after I did it. So I'm just going to change some numbers here. 1.7, okay, 920. Actually, I think I need about 910. Okay, but in any case, we're looking at just the math. Yeah, 2.4% maximum risk going into the trade. After closing, that call would have rolled to the August 18th. I don't even know if I'm going to see all the strikes I mentioned. 77 call and 82. And yesterday, due to high applied volatility, due to the known earnings event coming out, we could have sold that call for 260 and bought this one for 105. My risk would have been reduced to about 0.2%, and I would have left the upside open on the position. That's income method number 6. That's what happens with a bear call spread with just a stock ownership or the married put position. Hindsight 2020, knock on wood, I should have done this trade, and I believe I should have. But what I was actually contemplating is not just doing this. A lot of times I like to use this combination of income method number 6 and income method number 12 heading into earnings. And all I would have done here is for that same expiration, the shorter term expiration, I got a credit of 155. So I'm going to take most of that, which again is going to affect the risk. Oh, wait, I got to go back to the option chain. My apologies. And that's what I would have targeted, was the 70 strike at about $1. The 70 put. Get $1.55 in net credit. Buy that same expiration, 75 strike put. Oh, was it 70? I'm sorry, 70. My apologies, folks. Let me clear that out and get the 70 going. That lower strike put. I'm buying an extra put with the proceeds from my income method number 6. I'm only taking in 55 cents total of net credit. 260. Cost of that 82 call of 105. Cost of that 70 put at $1. Now here I have a bulletproof position at 3.7%. And where the stock is now, I'd be an extremely high profit position. I've done this before in other trades where I've actually fell into the 20, 25, 30% drop. Stocks like RPM, Penn Gaming was another one years ago in the RadioActive portfolio. And using this 12 and 6 and 12 approach, saw a similar drop. Something I should have done, and something we're going to talk about for Fusion subscribers and Blueprint owners webinars recently. Coming up, my apologies, coming up. But that's just, I know, that's a lot to digest. That's a fun thing. But that's sort of the power of the married put. What I should have done, but I hesitated. And this would have been the better return. Now, if I just left it alone, as I did, and the stock gapped up to 85, the profit on the married put would be higher than it is here. You know, going up to 84, 85, getting a 10-point gain, 8-point gain from where it was at 74, 75, 82, 83 target. Just with the married put I would have had a higher profit monetarily to liquidate than I would here with this contraption. But with what happens, instead of a loss of 2.4%, loss of about 1,200 on a gain of 1,200 on an investment of 7,115. So it's a little fun. It's a little complex, but just something we like to showcase once in a while. Something I like to do around earnings as well.